Most people think the stock market begins with a screen. A chart, a ticker symbol, a red number, a green number, a headline, a man shouting on television. That is the wrong starting point. If you begin with the screen, you begin too late. If you want to understand the stock market, you must begin with something much simpler. You must begin with a company. And if you want to understand a company, forget the logo for a moment. Forget the stock symbol. Forget the daily price. Think of a company as a basket. That basket is filled with things, some of those things you can touch. Buildings, trucks, tools, computers, inventory, warehouses, machines, land, cash in a bank account, and some of the things inside the basket you cannot touch at all. A brand name, a distribution system, a loyal customer base, a reputation, a patent, a habit inside the public mind, a software ecosystem, a way of doing business that others cannot easily copy. That is what a company is. A basket of valuable things, some visible, some invisible, some easy to count, some incredibly hard to count correctly, and the public keeps missing this because it gets hypnotized by the stock price before it understands the basket. Take Apple. People think they are talking about phones. They are only partly talking about phones. Yes, Apple has suppliers, inventory, stores, software, cash buildings, engineers, and all of the physical parts of a giant machine. Fine, but the more extraordinary part may be the thing you cannot hold. A brand so strong that millions of people will pay more for a product, not merely because of what it does, but because of what the name means to them. That is not fantasy. That is an asset. You cannot drop it on your foot. It may still be worth more than the warehouse full of phones. This is one of the first truths of business that people need to learn. The most valuable parts of a company are often the parts that do not fit neatly into a box. Once you see that, the rest of the subject gets much easier. Because the real question is not what the stock is doing today. The real question is who owns the basket. That is where money begins to separate itself into two big families, debt and equity. Or if you prefer the ordinary language, lenders and owners. Let me make it concrete. Imagine you are a carpenter. You have saved $10,000. That is good. In fact, it is more than many people ever save before trying to jump into something bigger than themselves. But it is still not enough. You need a truck, you need tools, you need enough working money to start taking jobs without feeling one bad week away from panic. $10,000 is helpful. It is not yet enough to build the machine. So you go to your friend Jake. Jake says he will lend you another $10,000, but only if you agree to pay him back in 1 year with 5% interest. Now you have $20,000. You buy the truck. You buy the tools. You start working. A year passes. And because I want to make the arithmetic vivid, suppose it goes very well. You make $50,000 in profit, not revenue profit. After expenses, after the fuel, after the materials, after all the little leaks that ordinary people keep forgetting about when they fantasize about starting businesses, $50,000 left, and you still own the truck and the tools. Now the question becomes interesting. How do you split the result? Most beginners do not understand this part clearly. Jake gave you money. Fine. Did Jake become half owner of the carpentry business? Number Jake became a lender. That is different. He does not own what is left after the good year. He is owed what was promised. His $10,000 back plus 5% interest, $500. That is the whole deal. Jake gets his $10,500, then he is done. If the business made $50,000 wonderful for you, Jake does not suddenly get half the excess. Why? Because Jake did not buy ownership. Jake bought a contractual claim. That is what debt is. A bond is simply that same logic formalized and scaled. Give me money. I will pay you back later. I will pay you interest along the way, fixed claim defined return, usually lower upside, usually lower risk. Now let us look at your side. After paying Jake back, what is left belongs to you. That is what ownership means. You absorb the uncertainty, you absorb the variability, you absorb the chance that the whole thing goes badly. But if it goes wonderfully, you keep what remains after the lenders are satisfied. That is what stock is in its simplest form. Ownership residual claim. Not first in line, last in line. But if the machine is good enough, what is left for the residual claimant can be spectacular. This is why the public keeps getting confused about stocks and bonds. Bonds look smaller in good times. Stocks look better in good times. So people say, obviously I want the stock to slow down. Now play the same story again with a worse year. What if the carpentry business makes nothing? What if the truck breaks? What if work dries up? What if customers delay payment? What if you overestimated demand? What if you were not nearly as clever as you sounded to yourself in the planning phase? Jake still wants his money. That is the point. He is owed what was promised, not a share of your mood. You may have to sell the tools. You may have to sell the truck. You may have to liquidate everything. Jake gets paid first. You get whatever is left, possibly nothing. That is why lenders accept smaller upside. They are structurally protected ahead of the owners. And that is why owners demand the right to all the remaining upside if the machine works. Bondholders get paid first, but only what they were promised. Stockholders get paid last, but keep what remains. That rule is not a side detail. It is one of the deepest rules in all of finance. It explains why stocks can be more rewarding and more painful. It explains why companies care about debt structure. It explains why bankruptcy matters. It explains why risk and reward do not float around as vague philosophy but sit inside the actual legal order of who gets paid first. Once you understand that, the stock market stops looking like a casino and starts looking like a claims market, a market where people buy and sell different kinds of claims on the basket. Now let us keep going. Suppose your carpentry business does not merely survive. Suppose it thrives 2 years pass. You are booked out. You are doing more jobs than one truck can handle. Customers from nearby towns start calling. You could stay small and make a fine living. Nothing wrong with that. But you decide you want to expand. You want more trucks, more crews. Maybe another city expansion takes money, and now you face the great capital allocation question every growing business faces. Do I borrow more or do I sell ownership? Borrowing more can work. But too much debt creates its own sort of fragility. The machine begins serving the lender before it serves its own future. You owe regardless of conditions. So perhaps instead of borrowing, you decide to sell pieces of your company. Your friend Maria buys in, Tom buys in, a few other people buy in. They do not lend. They buy slices of the basket. Their money goes into the company. The company becomes stronger. It has more capital. It can expand. That first sale of ownership to outside investors is the essence of what the world later dresses up in formal language as an initial public offering. An IPO is simply the first time a company sells pieces of itself to the public. The public hears IPO and imagines some exotic ceremonial event. At bottom, it is simple. The company says, here is the basket. We are selling ownership slices, bring us money. And in exchange, you get part of the residual claim. That first sale matters because the money goes to the company. That is another thing people keep misunderstanding. At the IPO stage, capital is raised for the business itself. After that, something changes once the company has sold those initial slices into the world. The slices can be traded between investors. Maria decides she wants out. Fine. She sells her shares to somebody else. That new buyer pays Maria. The company itself does not receive that money. You, the founder, do not receive that money either. Unless you were the one selling, the stock simply changes hands. That is the secondary market. And this is where so many beginners remain confused for years. They think when they buy a stock through an app, they are handing money to the company in some direct way. Usually they are not. They are buying a claim from another investor who is selling that claim. It is much more like a used car than people want to admit. Toyota sells the new car the first time. After that, used car buyers pay used car sellers. Toyota is not sitting there collecting another check each time the car changes owners. Stocks work similarly. After the initial sale, the claims move around among investors. This secondary market is what people normally mean when they say the stock market, not companies constantly collecting fresh money every day. People trading claims on baskets with one another, that is a very important distinction, because once you understand it, another question appears. If my money is not usually going to the company, why should I want the stock at all? The answer is wonderfully simple, because ownership can still become more valuable. There are two broad ways that can happen. The first is that the price of the claim rises. You buy at 50, you later sell at 100, you doubled your money. That is the part the public obsesses over. The second is that the company itself may decide to send part of its excess cash back to the owners. That is a dividend. If you own 100 shares and the company pays $2 per share, you get $200. Not because you worked that afternoon. Not because you wrote a new post about discipline, because you owned a claim on a machine that generated excess cash and decided to distribute part of it. That is a beautiful thing when attached to a good business. But not every company does it. Some companies keep the cash and reinvest it because they believe the best use of that money is still inside the machine. That is not automatically bad. In fact, for long stretches, it can be the most intelligent thing a company can do. Take a business like Amazon during much of its life. It kept reinvesting because there were still huge runways for growth. The cash was more useful inside the machine than outside it. Coca-Cola, on the other hand, has long been the sort of mature machine that can both operate and distribute cash because the reinvestment needs are smaller relative to the earnings power. Two very different situations. Both can reward owners, one primarily through internal reinvestment and long-run value growth, the other through a mix of value growth and direct cash payouts. The important point is not that one is morally better. The important point is that as an owner, you participate in the economics either way. You profit through price appreciation, dividends, or some combination of both. Now, once you understand what a stock is, the next question arrives almost automatically. Why does the price move so much if the basket itself is made of real things? The answer, again, is simpler than people want it to be. Supply and demand. That is all. If many people want to own the claim and few want to sell it, the price rises. If many want out and few want in, the price falls. People keep trying to make it mystical. Very often it is just appetite meeting scarcity. But of course the next question is why appetite changes, because people are always trying to look forward. A stock price is not simply a statement about the basket today. It is a vote on what people believe the basket may become. Apple announces a product people think will matter. Demand for the stock rises. A company reports poor earnings or weak guidance. Demand falls. A rumor spreads. A new regulation appears. Interest rates move. A competitor stumbles. A chief executive says something inspiring or foolish. The economy warms. The economy cools. The future becomes easier to imagine or harder to trust. And prices move today because opinions about tomorrow have changed. That is why the market can feel irrational in the short run, because short-run prices are a meeting point between facts and emotion. Sometimes the facts dominate, sometimes the emotion dominates, sometimes millions of people are simply afraid at the same time. Sometimes they are greedy at the same time. Sometimes the market is pricing real information. Sometimes it is pricing mood with a spreadsheet attached. This is why I have spent much of my life telling people not to worship the daily price. The daily price is useful. It is not holy. It is an offer, nothing more. The market says today, this is what somebody will pay for your slice of the basket. That may be reasonable. It may be foolishly high. It may be foolishly low. But it is still only an offer. If you do not understand the basket, the offer will control your emotions. If you do understand the basket, the offer becomes something very different, an opportunity or something to ignore. This is one of the reasons ordinary people get so twisted up in the stock market. They meet it through the wrong door. They meet it through price before ownership, through excitement before structure, through charts before claims, through speed before patience. And that is why so many of them are easy prey for the oldest expensive mistake in the business, trying to be clever, trying to pick the perfect stock, trying to predict the exact turn, trying to buy the dip and sell the top, trying to outsmart an ocean of professionals, algorithms, institutions, and other ambitious people all staring at the same public information. This is where I want to be very plain. Most professionals do not beat the market consistently over long periods. That is not an insult. That is arithmetic plus competition. So when an ordinary person with a day job and a real life decides he will consistently outplay the whole field with his intuition and some half-digested conviction from the internet, I do not call that ambition. I call that optimism with poor odds. The statistics are not kind here. And this is why, after all the complicated language, I often come back to the simplest answer for ordinary people. Buy a little bit of everything. There is a vehicle built exactly for that purpose. An index fund is simply another basket, only now. Instead of being a basket of trucks, tools, patents, cash, and brand inside one company, it becomes a basket of many companies all at once. You buy one fund. And inside that fund, you may own small slices of Apple, Microsoft, Amazon, Google, Walmart, Exxon, Visa, Johnson & Johnson, Home Depot, and hundreds of others, not because you personally studied every chief executive and every quarterly call, because the fund simply tracks the index. The most famous example in the United States is the S&P 500, 500 of the largest public companies in America. Buy an S&P 500 index fund, and you are not making one heroic prediction. You are buying a broad claim on the productive capacity of the American corporate machine. That is a very different thing. It is humbler. It is less dramatic. It is much harder to brag about at dinner. It is also one of the most rational wealth-building acts available to an ordinary person. Why? Because over very long stretches, broad productive enterprise has a habit of growing, not smoothly. Do not ever let anyone lie to you about smoothness. Some years are ugly. Some years are spectacular. Some years are flat enough to make you question your patience. Some decades can be disappointing if you pick the wrong starting point. But over the very long run, productive businesses reinvest. Innovate, acquire, fail, get replaced, expand margins, pay dividends, buy back shares, and keep dragging the whole machine upward. The average long-run annual return of the S&P 500 is often cited around 10% before inflation. People repeat that number so often that it starts sounding like a slogan. It is not a slogan. It is the rough historical result of owning a broad claim on American business for very long periods and then not behaving foolishly. That last part matters more than most people realize, not behaving foolishly, because the market's greatest weapon against ordinary people is not complexity. It is emotional interruption. The market falls. People panic. The market rises too much. People get greedy. Somebody on television sounds sure. Somebody online sounds richer than you. Some crisis appears, some bubble appears, and the person who began with a sensible index fund slowly talks himself into doing something dumb because the boring plans stop feeling emotionally satisfying. That is where fortunes leak away. Not in the arithmetic of the fund, in the impatience of the owner. This is why the truly intelligent beginner's strategy sounds so unimpressive. Buy regularly, buy broadly, keep costs low. Do not panic during drops. Do not demand excitement from the machine. Let time do what cleverness usually fails to do. That is the strategy. And yes, it is boring. Wonderful. Boring is underrated in money. Boring lets systems work. Boring lets compounding express itself. Boring lets you live your life while ownership does its quiet job in the background. The public has been trained to despise boring because the public consumes finance as entertainment. I consume it as economics. Economics has no obligation to thrill you. It only needs to work. And once you see the whole thing clearly, the stock market stops looking like a place where mysterious numbers dance. It starts looking like a simple human mechanism. Companies are baskets of valuable things, some tangible, some intangible. Bonds are loans into those baskets. Stocks are ownership claims on what remains. Bondholders get paid first. Stockholders get what is left. Companies sell pieces of themselves to raise money. Then those pieces trade among investors. Prices move because people keep arguing with each other about the future. Owners get paid through rising value, dividends, or both. And if you are just beginning, the safest great answer is usually not to guess which basket will be the best single winner. The safest great answer is to own a little of all the great baskets and let patience do the heavy lifting. That is what I would want you to understand, not only because it is correct, because once you understand it, a great deal of unnecessary fear leaves the room. The market stops feeling like a mysterious machine designed to embarrass beginners. It starts feeling like what it really is, a place where claims on productive assets are traded, nothing more, nothing less. And if you can remember that, then the next time you open the app and see the chart jumping around, You may be a little less hypnotized by the movement and a little more anchored to the underlying truth. You are not watching magic. You are watching opinions about baskets change price. That is a very different thing. And once you know that difference, you have already become a much better investor than the person who still believes the stock market begins and ends with a flashing number on a screen. There is another reason I want ordinary people to understand this structure before they ever try to pick a stock. It changes how they interpret fear. A person who only sees symbols and prices experiences the market as something happening to him. A person who understands baskets, claims, and ownership experiences the market very differently. He still feels fear. He is still human. But he knows what the fear is attached to. Not magic, not mystery, a temporary disagreement about what the baskets are worth. That distinction matters because the market will eventually hand you ugly days. It always does on those days. The beginner thinks the machine itself may have broken. The informed owner asks a much calmer question. Did the basket really become less valuable? Or did the crowd simply become more frightened? Sometimes the basket truly weakens. Sometimes the crowd simply panics. Those are very different events. And if you never learn to tell them apart, you will spend your whole life reacting to price while pretending you are investing. That is why I keep coming back to the same simple foundation. Own productive things. Understand the claim you own. Respect the order of who gets paid. Do not confuse the secondary market with the company itself. Do not confuse daily movement with permanent value. And do not let the availability of an app trick you into believing wisdom has become easy just because access has become easy. Access is easy. Now, discipline is not. That is why so many people can buy a stock with one tap and still remain completely lost about what they actually bought. I do not want that for you. I want you to know the basket, the claim, the order, and the machine. Once you know those four things, the stock market becomes much less theatrical and much more useful. That is where a real investor begins.